Today we want to talk about how do you play the consumer sector. Paul, you've been looking at it. What do you reckon?
Well, let's start with the big picture, Peter, of course, and look at some of the challenges the consumer or the consumer staples sector has in particular. Some of them, some what you call the macroeconomic headwinds, Peter. I mean, first of all, look, we know that the housing market is put the consumer under pressure, so falls in housing prices are potentially reducing what consumers have got to spend. Low wages growth, another negative. And thirdly, we've seen the household savings ratio under a lot of pressure. So they're all sort of leading to fairly depressed retail sales, up 0.4% in November, but only at 2.8% year-on-year gain. In terms of the more directly consumer spending, the food category of retail turnover, that's done a little better, up 4% year-on-year.
Not a bad number.
And reports that perhaps that price deflation has been in supermarkets is easing to the extent that maybe prices might be going up a little bit. But a very competitive landscape. I mean, not only have we got Aldi expanding across Australia, we've got new entrants like Kaufman and also Costco, and then Amazon coming into the space. So it's not getting any easier for our major retailers. The competitors aren't going away. And I still think this is a sector that you probably want to be underweight in.
Yeah, it's hard to get excited about. Let's go to Wesfarmers because it's kind of changed its relationship with the sector, hasn't it?
Yeah, undergone a major transformation over the last 12 to 18 months under the new MD. I mean, it's actually now classified as part of the consumer discretionary sector. It moved following the demerger of Coles. Let's just look at the transformation. We've seen Wesfarmers get out of coal mining, so they've exited both their mines there, got out of resources with their sale of Quadrant Energy, sold the Kmart tyre and auto business, and also, of course, Bunnings UK, they closed that. So lots of divestments, and now just a business which, of course, is the powerhouse of Bunnings Australia, which is about half their earnings, Officeworks, Kmart, the challenged Target division, and then finally an industrial and safety division.
Which a lot of people wouldn't even know about.
Yeah, some variety of business from fertiliser all the way through to making industrial safety gloves and other things. But look, it's still a conglomerate, but it's now very firmly in the consumer area.
What's the balance sheet like?
Well, that's, of course, when you sell all these assets, you get able to repay debt. And, of course, what's happened is that debt will be down to about $300 million by the 31st of December. So basically net debt almost of zero. Lots of room for acquisition. And really that's what the market's waiting for, Peter, because it's one thing to sell all your businesses. It doesn't actually create any wealth. It repays debt and creates a better balance sheet. And the MD said he wants to invest in higher growth, higher ROE returning businesses, but has not yet been an acquisition and no suggestion what it's going to be. So the jury's out about what Wesfarmers is going to do next.
Okay, and it's trading on a reasonable multiple?
Well, look, the multiples come back, and let's put up the earnings graph, the price graph, and this perhaps shows it best, Peter, because Wesfarmers was trading in an incredibly narrow range for quite a few years. It spiked for some reason because people got excited about the demerger of Coles. It's come back into the low 30s. This is adjusted for the Coles demerger, and probably, it's now sitting at reasonable value. But, again, the question is, what is it going to do next? On an earnings multiple, it's trading about 16 times FY19 projected earnings, 14 times FY20. We've had a bit of a trading update to say that sales in Kmart were been a bit tough the last 6 months. In fact, they went backwards in the last 6 months on a same-store basis. The rest of the areas are okay. But it's one of these stocks, I quite like it, but I just can't yet get excited about wanting to buy Wesfarmers.
Yeah, I'm the same with you. Woolworths, Paul?
Well, Woolworths is the other extreme because this business is trading on a pretty high multiple. Let me go straight to the share price graph, Peter. And I think that's worth saying because it actually says the market actually likes Woolworths, has for some period of time. It's been really well supported between about $27 and $28. And is now, there's not much movement there. The market thinks Woolworths could do better things. Certainly it's been a recovery stock. It seems to, when we've seen retail sales have picked up. Had the plastic bag fiasco, it probably was the worst affected of the retailers back in when that was in June, but it seems to be over that. Still has the big W problem child to resolve. But I think the market likes Woolworths because it's probably the strongest candidate for some type of capital initiative. Wesfarmers could also do one, but doesn't have a huge surplus of franking credits, whereas with Woolworths, they are sitting on a lot of franking credits, so we could look at some sort of off-market buyback or special dividend. Trading on a multiple of about 21 to 22 times FY19 earnings and 20.7 times FY20 earnings, so it's expensive. and reports on the February the 20th. I mean, I quite like Woolworths simply because it doesn't want to go down, but you know, it's a pretty expensive stock.
Yeah, but if you're holding it, there's no compelling reason to really add to it at this point in time, apart from the hope that there might be some capital management.
I don't think there's any reason to sell it, Peter. I think the capital management initiatives, which we expect to see, and guess with their report we'll get the announcement or something, should keep that price pretty well supported. It's a defensive stock, and that's another reason people aren't going to abandon in the short term.
Okay, let's look at Coles for the first time, Paul, as an individual stock.
Yeah, I mean, Coles is not your classic demerger. I mean, we all know it was demerged back in November, but usually with demerged companies, they're unloved. They're the problem child. They're the ones the company has had no attention for, don't spend any capital on.
Like South 32 was.
Like South 32. Coles is not that. Coles had a lot of Wesfarmers capital. It had about 60% of the Wesfarmers capital invested in it, and wasn't a problem child and wasn't unloved. So some of the argument about why it gets demerged and why it's suddenly going to exceed as a demerged company, I don't think stacks up. That said, look, it's trading on a pretty cheap multiple. It's 17.4 times FY19 earnings and 15.620. The market thinks it should be at a discount relative to its major competitor Woolworths, but it's not sure how much it should be. I think it's going to go through the pattern of other demergers, Peter, and typically demerged companies don't do well for some period, and that's because people like you and I suddenly find we've got Coles shares, don't know what to do with them, don't really want them, small parcel, there's lots of selling pressure.
Yep.
And typically demerged companies struggle for about 6 months. I think Coles is in that same category, but it could be one to mark on your radar because it is cheap, but I just think it's a little early to buy yet. The other challenge with Coles is its earnings have actually been declining year on year. And despite, getting back in the sales war, I mean, so the supermarket business is challenged.
Yep,
and I can't see those challenges rapidly going away.
Sum up, how are you going to play consumer sector?
Well, I'm still going to play the stock from a pretty defensive basis. I think it's going to be liked because the market's, people want some yield, they want defensive yield. So there's going to be support for it, but I'm going to be underweighted. I think of the three stocks, I'm inclined to go with Woolworths simply because I think the capital management initiatives are most likely to happen, and that'll provide support. Wesfarmers, not a buy yet, and Coles, I'm going to look at Coles in a few months' time when I think most of the demerged selling pressure has started to ease.
Yeah, I'm like you, I'm a holder, but I'm not an adult when it comes to these stocks.